Hello, everybody. We are Group 8, the Blockchain Gang, and we are doing cryptocurrency as an asset class, challenges, and outlook. First off, recognizing cryptocurrency as an asset class. Over the last 5 to 7 years or so, the popularity of cryptocurrency has skyrocketed tremendously, with influential figures like Bill Gates, Elon Musk, but most importantly, financial groups like Goldman Sachs becoming huge endorsers to the crypto system. Even so, countries like El Salvador have adopted the crypto coin Bitcoin as legal tender, and on top of that, hundreds of millions of crypto users can be found worldwide. Next, looking at crypto's functionality and characteristics, crypto is largely considered a legitimate store of value by many people, which increases its liquidity and acceptability compared to traditional asset classes. It's easily transferable and has a fixed amount of supply, and on top of that, blockchain technology and proof of work allows for cryptocurrencies to be secure, verified, and counterfeit proof, reducing the risk to an investor. Lastly, we would like to emphasize that crypto is its own bona fide asset class. And looking at performance history against other asset classes, its low correlation to other assets are just some of the factors that allow for a strong case for crypto as its own distinct asset class. And to help better understand this reasoning, we'll look at statistics and data revolving around crypto as an asset class in the following slides.
Some of the characteristics of an asset class include security, privacy, and transferability, and thus giving it the potential for widespread adoption. Here's a chart comparing cryptocurrency adoption rates to the internet in their infancies. Both of these technologies started with approximately 5 million users. If we compare the positive regression of both, they are very similar, and over a period of 6 years since its inception, crypto has grown more than 137%. If we were to take the internet model and predict the future growth of crypto, 1.2 billion users will claim cryptocurrency as a digital asset by 2025. And by 2030, that number would grow to 5 billion, becoming the dominant source of owning, transferring, and recording value in contractual terms globally. For an asset to add value to a portfolio, it must offer an attractive reward according to its risk and possess low correlations with other assets in order to benefit from portfolio diversification. Goldman Sachs senior strategist Christian Muller-Glissman states that just a tiny allocation of Bitcoin to a standard 60-40 portfolio would outperform any stocks from the S&P 500 due to the higher risk-adjusted returns of Bitcoin. Even 5% Bitcoin mixed into a portfolio has increased returns by 25%. But the argument against cryptocurrency to be considered a macroeconomic asset can be seen by looking at gold. Gold is both a useful commodity and also a store of value. Gold was long used as an international monetary standard before the 1944 Bretton Woods Agreement, which replaced it with the US dollar. Gold is also anti-inflationary as its price rises along with inflation. The most critical factor in the influence of nominal exchange rates is the rate of inflation, and this allows gold to be a very useful diversifier and low correlator in investment portfolios. The issue with Bitcoin is that it has had high idiosyncratic risks from the beginning. As stated above, just a small allocation of Bitcoin, around 5%, greatly enhanced the risk-adjusted returns of portfolios in the US. These gains were contributed to 3 separate peaks, and the most recent high was explained by the COVID-19 pandemic. The allocation of 5% in portfolios was the force behind 20% of the overall volatility in portfolios, while other assets, such as US T-bills, represented only 2%. This high idiosyncratic risk is desirable in terms of diversifying a portfolio, but Bitcoin's volatility represents an unreliable alternative to other stable assets such as gold. This is especially important for shorter time horizons and increases risk to balanced portfolios from a timing perspective, which would require frequent rebalancing.
Blockchain and digital assets constitute over a $2.1 trillion market, making its aggregate value larger than Canada or Italy's GDP. And with over 200 million users, crypto-based digital assets have a high possibility of forming an entirely new asset class. Blockchain increases trust, security, transparency, and the traceability of data shared across a business network and delivers cost savings with new efficiencies. Cryptocurrency innovations have the potential to bring great benefits to emerging economies around the world, and increased use of these assets strengthen this idea. Some of the most popular and recent innovations include NFTs, proof of stake, DeFi, smart contracts, and more. NFTs, or non-fungible tokens, are a blockchain-verified asset in which transactions are recorded using blockchain technology. Proof of stake, or POS, is a consensus mechanism which is used to validate the authenticity of cryptocurrency transactions through allowing owners of a cryptocurrency to stake coins and create their own validator nodes. Centralized finance involves banks and other third-party intermediaries, but DeFi, or decentralized finance, uses emerging blockchain technology to remove third parties in financial transactions. In simple terms, a smart contract is a transaction agreement which cannot be altered between two parties that is stored and processed in the blockchain in the form of computer code. New blockchain innovations have made it so that the need for a third party ceases to exist, and extra taxes, fees, and interest, which are normally incurred between transactions, can be fully eliminated. Crypto assets which use blockchain may soon gain the acceptance and participation of institutional investors. Their unique value propositions offered by blockchain, including but not limited to functionality, security, ease of transactability, trustworthiness, and simplicity, without the incurrence of extraneous fees, make the idea of adopting blockchain as a new asset class not only tempting, but very likely in the near future.
Although cryptocurrencies are taking off and the public seems to have great trust in them, there are still several challenges and limitations that must be acknowledged. Taxes and regulations surrounding cryptocurrencies are currently in an exciting place. Given the popularity of Bitcoin and its growing use, countries will inevitably align their legal and tax systems to it. Cryptocurrency taxation is a touchy subject in many parts of the world. Currently, there is no worldwide standard for determining whether cryptocurrency should be treated as cash or property, and what stages of the cryptocurrency lifestyles are taxed, and what the income tax, value-added tax, and other tax implications are. On top of that, it is considered an intangible property, which is also subject to capital gains taxes. When investors buy Bitcoin and sell it at a higher price, they'll be required to show the differences in their taxes. This requires diligent record keeping, and if not well kept, it could lead to problems with the IRS. Another concerning challenge and limitation of cryptocurrency is the future security of the asset and inheritance. In decentralized blockchain technology systems, there are no central control authorities. This means that each user must be aware of their specific job, the tasks and obligations that come with it, as well as the hazards that come with it too. A user's private key is the primary means of executing transactions and controlling their Bitcoin and digital assets. As a result, key management is crucial. If a user lost their private key, they will be unable to regain access to it or request a new one from central authority. A private key can only be restored if a proper backup solution is in place. This could be a problem because if a loved one or a relative suddenly passed away, there is no access to their digital wallet, and the investment is essentially lost. The solution to this would be crypto custody. However, that has a slew of risks as well. Passing on private key leads to three leading trusts: confidentiality, availability, and integrity. If any of these controls are broken, it further reiterates the questions behind the capabilities of cryptocurrency becoming a legitimate asset.
As we know, there are many challenges and risks when it comes to crypto, but that also means there are new opportunities. The increasing value and popularity has attracted businesses and agencies to start accepting Bitcoin as a medium of exchange. Endorsers, users, and many professionals in the sphere believe that cryptocurrency can one day replace physical cash. After conducting extensive research on cryptocurrency as an asset, we can confidently say that this is something within the realm of possibility. Through sharing similar essential characteristics as other assets, important digitalized technology innovations like blockchain, we can conclude that crypto has the base requirements to be universally used as an asset in today's modern economy. Cryptocurrency has also opened new career opportunities in the industry. As finance majors, this provides many opportunities, as firms are currently looking for experts to help guide them with this new technology. Looking at cryptocurrency today, there are currently one of the most high-profile lawsuits in the financial service industry. The Securities and Exchange Commission sued Ripple and accused them of raising $1.3 billion in unregistered digital asset securities, which rocked the crypto and blockchain community. The case centers on the fact that XRP is a security and not a currency, and so it is subject to rigorous security rules. The outcome of this case will determine the future of cryptocurrency, because if XRP loses, cryptocurrencies will no longer be able to utilize private funding, thus making it difficult for expansion in the crypto realm. It is also concerning because cryptocurrencies will need to register themselves as a security, which goes against what crypto is. However, if they win, it'll encourage more projects to come, and more importantly, it'll set a precedent for future court cases in the crypto community.